Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are, and you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time.
All right. Hello, and welcome to the Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could follow, rate, subscribe, review it wherever you're watching or listening to it. With me today, I'm happy to have on one of the people, actually, I'm not even going to say one of the people's favorite guests, Jeremy Raper. Jeremy, how's it going?
It's going great, Andrew. Always a pleasure. How are you?
Jeremy, I was just surprised. I said Jeremy Raper is coming on. We were kind of keeping the name of the company under wraps until you released your open letter. Do you have any questions for Jeremy? And the questions, I mean, we're approaching Warren Buffett at Omaha level. It's just, Jeremy, what do I do with my life? Jeremy, how did your hair become so long and flowing and beautiful? It was wild. But let me start with the disclaimer. Nothing on this podcast is financial advice. That's always true, but probably particularly true today. Jeremy and I are going to talk about a very small cap, a kind of levered company that Jeremy is going activist in. So obviously there's all sorts of increased risk there. And then I think we might kind of flow through a couple of other names. So everybody should just remember there's plenty of risk here, not financial advice. Please do your own work. Anyway, Jeremy, the reason you came on today, we wanted to have you on today, is because you took a position in a company and recently this morning published a letter to them. The company is Alto Ingredients. The ticker is ALTO. And I just want to toss it over to you. What's going on with Alto? Why did you take a position? What did you want to get done with the letter?
Sure. Okay, so just at a very, by the way, thanks for having me back again. It's always a pleasure. At a very high level, I'm going to try and dumb down some of the lingo because as we'll go through, there's a lot of kind of terminology with regard to regulatory credits, tax subsidies, what have you. I'm going to try and keep it as high level as possible so that people can understand. But I did write an open letter to the board of Alto. You can find it on my website, rapercapital.com, under the engagement section, or probably easiest is if you follow either Andrew or myself on Twitter, you'll probably find it in some of the comments. So you can read that letter by way of background. But essentially, Alto is a commodity ethanol producer. And they have two main campuses. One is kind of a high quality, fully invested, integrated mill called the Pekin campus, Pekin, which is in Illinois. That has about 250 million gallons of total capacity, of which about 65%, call it 60, 140, 150 million of that 250 is what I would grade as specialty grade. So it's not actually commodity ethanol. It's kind of, they've invested to make it produce a higher value content, protein content product than vanilla fuel ethanol, which just gets sold as a blending agent into gasoline, right? And the rest of that facility is essentially fuel ethanol. Then they have two further plants out west, one called Magic Valley, one called Columbia, which are smaller subscale dry mills, so not as high quality product that can't produce this specialty grade. So all in capacity is 350 million gallons, I should say, 250 million very high value in Illinois, two smaller plants out west. Now, I don't mean to give too much by way of background, but I think it's quite important. So the ethanol industry is a pretty horrendous industry, to be frank. The main problem is it's beset by overcapacity because a lot of the ethanol production facilities are owned by farmer cooperatives. And essentially to make ethanol, you ferment corn. And so if you're owned by a farmer cooperative, they're much more interested in, selling the corn into the ethanol producing facility, into the ethanol fermentation process than they are about actually making money on ethanol. So historically, we have this big problem of overcapacity in the industry that was solved by an export valve. That export valve was predominantly China. But then when Trump came in 2018, I think it was, he slapped a bunch of tariffs on all kinds of products from China, and China responded by slapping huge tariffs on US ethanol. So it almost closed the Chinese market to US ethanol. A lot of that ethanol actually goes to other places like Canada now. And it created this big imbalance in the market in the US. So it's kind of in a structural overcapacity, but because a lot of these ethanol facilities are owned by farmers, they didn't drop out of production when prices collapsed. they kind of stayed as loss leaders because they're there to essentially buy corn. So it's kind of a prototypical commodity industry in a state of, I don't want to say semi-permanent, but chronic overcapacity. And as a result, it's kind of beset by your typical commodity, vicious cyclicality, price swings, what have you. Now, initially coming out of COVID, so that's kind of overall background. Initially coming out of COVID, ethanol, a lot of ethanol names actually did quite well for a period. One, driving demand. You may recall the summer of 2020, driving demand was insane because everyone stayed at home. So actually, driving demand, which is essentially the main driver for ethanol demand because of the blending, surprised to the upside, and stocks have been run down because a lot of facilities were closed during COVID. So you actually saw a big pickup in pricing. Combined with that, a lot of these facilities lucked into a huge windfall from alcohol sanitizer. So one of the value-added ingredients that a lot of these guys make is actually an input into hand sanitizer. So the price of this stuff went up, 10x or whatever. So just going back to Alto for a second, they made 60, 70 million of EBITDA in 2020, 2021. So these were kind of banner years, like 5, 6, 7 average year. EBITDA is more like 30, 35 million. So when they're making 70 million EBITDA, that's kind of like a really, really good year. But it was really kind of driven by these two factors: this temporary imbalance in the market because of COVID shutdowns, what have you, then surprising demand and driving related demand, combined with this insane profitability of sanitizer that lasted for 12, 15 months and then completely died. Now in 2022 was the complete opposite. By 2022, the market's kind of collapsed for a few reasons. Obviously, a lot of that idle capacity had come back. More importantly, there was a lot of idiosyncratic issues with regards to feedstock. So, Andrew, you're involved in all these things. You followed what happened last year with very closely with supply chains bottlenecks. But essentially what happened was you literally had lightning strikes in some of the rail systems in Illinois, which really affected Alto in particular. They're the largest user of the Union Pacific railroads. So that really hurt them. But you had other things, like you had a massive explosion in natural gas prices. Natural gas is one of the main input costs for production of ethanol. So you not only do you have, obviously, nat gas went to $9 Henry Hub, you also had a big explosion in local basis costs for nat gas. So Illinois-based nat gas actually blew out, even more so than your generic Henry Hub pricing, which is very expensive. So you had a big explosion in input costs. You had a huge increase in rail costs, freight costs. You had, beyond just the pure cost, you had bottleneck supply chain issues. You couldn't actually get corn where you needed to get it at certain times due to labor issues, strikes, what have you. And then you also had an explosion in corn basis, meaning the difference between the futures price of corn and the actual delivered physical cost of corn. Now, this is important because to make ethanol, you have to ferment corn. You can't just buy it on a screen. You actually have to get it from a granary. And so some listeners may be familiar with aluminium. There's what's called a Midwest premium. It's a similar concept. You trade it on the screen, but when you get delivery of the product, you have to pay a premium for physical product. That premium moves around just like a market. There's a market on that premium, and it's called basis in ethanol. And that blew out last year as well for some of the reasons we discussed: supply chain issues, some local idiosyncratic issues, also things like the Ukraine war, which really tightened the global wheat market. And obviously that's related to corn as a food input. And so there was a huge demand for corn to go to other places other than, the Midwest. And so the basis absolutely exploded. So you kind of had too much ethanol in the system, combined with higher input costs, combined with a few other idiosyncratic issues, plus massive increase in kind of OPEX, nat gas, what have you. And so profitability just collapsed. And so last year I don't have the numbers in front of me, but fourth quarter, they lost money at the negative EBITDA level. First quarter this year, substantial negative EBITDA. It's low single digit EBITDA on the full year, basically.
I had the 8K pulled up, so they did negative 4.5 million of EBITDA in Q1 23. So they were negative, and the DNA for, you've got these big refineries, like the DNA for these ethanol product, the DNA is real here. So if you're slightly negative on adjusted EBITDA on a like cash all in basis, it's quite negative once you account for that maintenance capex. Definitely.
So again, so very high level by way of background, it's important. So while this was all going on, Alto's stock, for most of 2022, it was kind of like a $5 to call it $6 stock. Maybe it was above there slightly early in the year, but by the end of the year, it was kind of like a $3 stock. And then they reported the 4Q numbers in early 2023, and the stock just got absolutely obliterated. I mean, it went from $3.50 to the low was like $1.30 or something. And the reason for that, obviously the fundamentals have deteriorated massively, but more than that, the balance sheet, which had been actually quite clean until a couple of quarters ago, had deteriorated pretty rapidly. So they managed to go from a chronic net debt position to actually a decent net cash position over the last 18 months as they sold a lot of non-core assets and managed to generate some cash through the kind of good years 2020, 2021, as I mentioned, but mostly through asset sales. But then at the end of 2022, they made the curious decision to draw down a lot of debt, very expensive debt actually, 11% all-in cost of debt, first lien, super senior paper, claim on all the assets kind of debt, with an equity kicker as well and an original issue discount 1.5%. Because kind of the way to get away from this commodity ethanol purgatorial cycle is to kind of move into higher value added products. So I mentioned before that some of their capacity has already kind of been semi-upgraded and can produce value added products. Essentially what they're trying to do is get out of the commodity business of making fuel ethanol and in making higher value added products where they essentially extract more protein from the ethanol molecule and sell it as kind of like animal feedstock or an ingredient into distillers grains. So making alcohol, beverage ingredient, or hand sanitizer is one example, but those kind of other consumer facing product inputs, which obviously trade at a much, much higher premium than your kind of $2.30, $2.50 a gallon, which is kind of what ethanol trades. So in order to do that, they have all these different investments they're doing. And by the way, I'm talking, they're doing, you can pull up they do have a good slide deck from their 4Q report where they go through a lot of their investments. And it's really a laundry list of different things from new corn silos to...
On their earnings calls, they talk about them and it's like 6 paragraphs long, all the descriptions. And whenever you see it, you're like, what is this, a $500 billion company that's like talking about all it's crazy how small they are and they've got all these different investments they're talking about.
I mean, it's really all over the place. There's at least 7 or 8 different things. And it's not that there's 7 or 8 different things tied into one facility or one product. They're really disparate projects. So at one facility, they'll be building a new corn storage facility. Then they'll be trying to increase their corn oil yield. Corn oil is a byproduct of ethanol. It's an input into renewable diesel. It's actually a high value product. So they'll be trying to do that, which is a good thing. Another one, they'll be trying to increase their primary yeast production, essentially towards the drinking alcohol industry or what have you. Then they're going to do a cogen plant, to try to become more efficient at the core Pekin campus. Now, then they have the carbon opportunity that we'll spend a lot of time on. I mean, literally a laundry list of different things. Half of them are to do with the core Pekin campus, which, as I mentioned, is kind of the crown jewel of the company. But a lot of them were still to do with these structurally challenged Western assets, which, I have a bit more of a problem with. Anyway, so they drew down this extremely expensive cost of debt to theoretically fund a bunch of these projects, but not actually the projects that I think have the most value. And I think the market has the most value. And these are the decarbonization related projects. So essentially what you have is a company trying to undergo a pretty fundamental corporate transformation from a commodity ethanol producer to a value-added protein and derivatives producer, with a lot of carbon-related opportunities that have relatively recently come to the fore after the passage of the Inflation Reduction Act. So the Inflation Reduction Act is a piece of legislation passed in the summer of 2022 by the Biden administration that I go into some detail in the note at a high level. I mean, it's very technical, obviously. It's kind of like a 2,000-page document. But essentially what that legislation did was completely change the value and use of invested ethanol plants because you're taking this thing that produces a commodity grade fuel input essentially, but ethanol could be considered separately as a pure carbon dioxide factory because as a byproduct of the biogenic fermentation process, it's one of the few industrial processes that spits out almost pure carbon dioxide. In other words, so again, backing up a little, if we were to talk about carbon capture, which we'll discuss in a moment, the number one benefit to, I guess that the easiest way to capture carbon is if it's a very, very high purity off stream in the off gases of the biorefinery, because the higher the purity, the easier it is to capture essentially. So conceptually, if you think about it, I guess I didn't really go through what
I think a simple way,
I should probably go through that.
Green Plains GPRE,
yes,
which is a much larger, much more successful competitor with lots more specialties, but they held an investor day, which I know you read, and an IRA teaching, which I know you read and really liked. And one of the things they said, like, look, the corn molecule, if you think about it, when you turn it into anything ethanol, like it's just releasing pure carbon dioxide, right? Like a little tiny corn kernel is basically a storage of CO2 is how you can think about it. And when we do anything with it, all of that CO2 escapes. So if we can capture all of that CO2, as you're saying, it's pure, you're capturing it, it's pure, it's the perfect thing for carbon capture if you can capture it.
Exactly. And so just to recap, carbon capture and sequestration, CCS, this is I don't want to say it's a novel concept. It's been done in various forms for well over a decade by certain industrial players. But under the IRA, it is being massively incentivized through these crazy generous subsidies. So the whole reason these ethanol plants now have massive value to financial buyers, strategic buyers, what have you, is that in this 99% pure carbon dioxide stream, if that can be captured, stored, and sequestered meaning injected into a geologic formation underground such that it can be contained for 1,000 years without permeating into the surrounding rock or sediment. If that can be accomplished, the US government is going to pay you a crazy amount of money. And there's two different kind of subsidies that they're offering under the IRA. Well, they existed before the IRA, but they got beefed up on the IRA. One of them is called 45Q, and one of them is called 45Z. I'll save the technical description of the actual terms. People can read my note and look at the math if they really want to know, but I keep it very high level. Just on the Pekin campus alone, the Pekin campus produces over 700,000 metric tons of almost pure carbon dioxide a year. Just on the Pekin campus alone, forgetting the Western assets, I think the carbon capture opportunity alone is worth over $140 million EBITDA, fully invested. And you have to invest to build the machinery to capture the carbon. You have to pay to store the carbon. You have to pay someone to transport the carbon to a site, of course, but 140 million of EBITDA. Putting that in context, as I said, 2-3 years ago, a very good year of EBITDA was 70 million. I mean, this is totally and utterly transformational. And again, this is kind of 2 levels deep of this carbon opportunity. And I won't go into too much detail, but as you decarbonize your operations, it opens up other levels of subsidies and other new products, such as sustainable aviation fuel, that get all kinds of different subsidies, not just from the federal government, but actually from state governments as well, that could be of extreme value. But I'm not building anything in for that. I'm literally building in the value of 45Z credit, which is kind of like the vanilla number 1 credit that everyone's going for. And then LCFS, low carbon fuel standard, which is an established carbon market in California, Oregon, I think Canada as well. I need to double check. Where basically, if you've decarbonized through capturing the carbon, then your ethanol becomes clean ethanol, I think green ethanol, whatever they call it. You sell it into California, and you get an extra $80, $90 per ton just for that.
And now, a quick word from our sponsor. Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are, and you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time.
I think there's more we could talk about with the specifics of each individual subsidy and everything, but I guess let's jump, we're 20 minutes in, so let's jump to the heart of the matter, right? Like there are all these ethanol in general, like it reminds me of a few companies I followed where you've got these assets and all of a sudden you luck into something that's super useful, right? Like at the heart of COVID, if as you said, if at the heart of COVID, if you could make hand sanitizer, all of a sudden you had the greatest boom of all time because the demand was literally unlimited and supply was fixed for a while. For last year when all the Russian oil gets banned, if you could ship oil, if you were an oil tanker, all of a sudden demand goes through the roof and you get lifetime profits. It's insane. So they've lucked into basically the IRA is just perfect for everything. They've lucked into this thing. They've got a lot of things that they can produce, but I guess where I wanted to jump to is, what are you calling on them to do, right? Like, what are you here? You've bought up a serious stake in the business. You sent a letter to the board. What do you want them to do?
Okay, I want them to sell the company, but more specifically, I want them to divest the Western assets. So the suboptimal, smaller capacity kind of non-scale assets. I wanted them to divest those and then run a full auction for the Pekin campus. My thesis is obviously this generic thesis around ethanol assets, well-invested ethanol assets being highly valuable. That's the general thesis. The specific thesis about Pekin is that this is a strategic asset now because of its location. So the key about carbon capture, anyone can, okay, I don't want to go too high level. Anyone can theoretically build the infrastructure to capture the carbon. The real value in use is transportation and storing. Carbon dioxide has to be transported as a liquid at about 10 times the pressure of natural gas. You cannot actually use a natural gas pipeline to transport carbon dioxide. You need a special pipeline. So the actual bottleneck to a lot of carbon economics is the distance you have to pipe it from the source to the storage site.
Yep.
Pekin has two hugely valuable options. One, they could theoretically do what's called direct inject, meaning they basically just dig where they are underground, and if the geologic quality, 500 meters below the earth is of a relevant and the right quality, then you could theoretically store your carbon there, because Pekin sits on the middle of the Illinois basin where it has these kind of geological structures necessary to store gases deep underground. But even if they can't do it directly at the site, guess what? They're only 70 miles away from one of the world's largest operating carbon capture storage facilities, operated by Archer Daniels Midland in a city called Decatur, Illinois. It's near Peoria, if anyone is from the Midwest. So instead of being based in the middle of nowhere in North Dakota, where a lot of these, they're in the Corn Belt, right? So a lot of these ethanol facilities are in the middle of Wyoming or Nebraska, or whatever. They're 70 miles away from a picture perfect site. They could easily they don't even have to build a pipeline themselves. Pay ADM a fee and store their carbon right there. So it's situationally unique. It's a well-invested asset, meaning it has a wet mill. They've already made a lot of the investments necessary to actually add value to the finished product. It's a perfect site for carbon capture. I mean, it's of scale as well, right? It's not like a tiny facility. 250 million is a solid level of production capacity. And actually, having spoken to some industry experts, there's upside. There's brownfield capacity expansion. So there's upside to an acquirer to increase production capacity another 30, 40, 50 million gallons, obviously to capture the carbon on top of that, if or when they develop that. So it's locationally advantaged. It would have a huge value in use to an acquirer. And my thesis is, look, Alto is currently capitalized, is just not in a position to make the necessary investments, okay? They do not have the balance sheet required. That was demonstrated late last year when they went and got this kind of usurious loan, point one. Point two, when the equity just absolutely collapsed and cost of equity exploded, the market is just not there for them, okay? The capital markets are just closed. They don't have the wherewithal. More importantly, they don't have the track record of successful execution. Like,
yep.
People talk about Green Plains. Okay, Green Plains is an excellent company. I'm not as near current on it as I should be, probably. It may be a very interesting investment in the coming years. They're miles ahead of Alto in terms of where they are, both on the protein side and on the carbon side. And even they are being called upon by activists to do something with the business because, they're a $3 billion company, what have you, with a billion gallons of capacity. And even then, some of their shareholders think that doing it in the public markets is going to be too tough, take too long, and potentially be too risky. So, Alto, you can pull up the long-term shareholder return chart. It's kind of 10-year shareholder return is like negative 60%. It's kind of been perpetually undercapitalized and poorly managed, has a horrendous record of capital allocation. They do not have the credibility. They don't have the capital. Frankly, they don't have I'm sorry to say that they just don't have the what I would call the executional know-how to proceed with a corporate transformation like this. And because of that strong industrial logic to selling the core asset, that combined with the financial upside to the owners of this business, meaning the shareholders, makes it a no-brainer. Because here's the rub. Today's stock is $2.80. That's about 50 cents a gallon in terms of the valuation of the assets, invested capacity. Green Plains got on their 4Q call and said, look, people are bidding $1.50 a gallon for invested assets of scale, meaning 100 million gallons or greater of capacity. People are bidding $1.50 a gallon and aren't even getting invited to the second round.
Yep.
Replacement value on assets, not wet mills necessarily, but even dry mills, probably about $2 a gallon. For something like Green Plains, it's much higher because they've been spending a lot of money to kind of add value to the assets over many years. But for a vanilla kind of ethanol asset, it's probably about $2 a gallon. This thing's trading at 50 cents a gallon. All right. You just total up the working capital and give 40 cents a gallon for the crappy Western assets. you get 650 a share. Stock's at 270, 280. I mean,
if I can just add
yeah,
there, I'll include a link to Jeremy's letter, but even more, Jeremy's letter values, you can go look. Appendix A just values the Pekin campus at $1.70 per gallon. Cut it down to $1.50 if you really want, but at $1.70 per gallon, that's that comes out to $425 million in value. The whole company right now is valued at an enterprise value of just slightly over 300 million. So you're talking about the Pekin campus covers all of the value plus some, and then you would get another, 40, 50 million from the other things. Plus, if you want to give them credit for some of the
working capital. Working capital is very large.
Pekin campus covers everything.
Yeah, so just to be clear, they have 120 million of net working capital. I give them credit for maybe 2/3 of that. So, and the reason I do that is because in prior transactions, they have sold a fair few assets in the past, and other guys like Green Plains have divested assets. When they trade these assets, they do tend to get recredited for the working capital that goes with the business. So I'm not treating it fully as cash, but there is some cash-like value there. So, but basically, go on.
Oh, I was just, and that would go to the working capital. Like a lot of these things, like some you get just because you get it back, and like there's a big working capital investment in having the inventory and everything, and you can deal with that one way or the other. But another thought is, look, a big strategic player who comes in, if they do it and they're selling hundreds of millions of barrels of things, they generally are going to get better terms and everything. So they're dealing with the same thing. They can probably optimize and trade around. I guess the point I was trying to drive to ineloquently is if they sold to a Green Plains or somebody larger, like the plant, obviously you need the people working on the ground, but there's actually going to be real operational synergies where you sell up to the person where, hey, you only need one account manager. Guess what? We're going after a lot of subsidies. You do need lobbyists. You do need regulatory people to like check all the boxes. Well, they're already doing 10 plants. You can toss this one plant on there. As I'm saying, you're going to get better working capital terms. You tend to be able to get a little bit of, hey, we were fulfilling this contract from a plant 100 miles away. Alto's plant's a little closer, so we'll do it there, and we get a little bit of synergies there. Like there just tend to be a lot of those little things when you go from being basically a one plant company to selling to a strategic.
There should be. That kind of ties into something I probably should have spent more time on the letter, but I didn't. There should be tons of potential acquirers for this asset.
Yep.
Not just financial buyers for sure. Like, as I said, if this thing's going to be doing 140 million of EBITDA, kind of level 1, level 2 EBITDA before you consider these add-on options, and you're paying 3 times EBITDA for it. Look, all the renewable businesses we focus on, these all trade near double-digit multiples or high double-digit multiples. Yes, this needs to be proven out. Yes, this isn't EBITDA next year. It's probably 2.5 years out, but nothing's sexier than carbon capture. It's a very sexy story. 3 times EBITDA for, as I said, kind of low-hanging fruit numbers. This should be very, very attractive. That's the financial buyers. Then there's a whole suite of strategic players who would love to invest, I believe, in something like this, from everyone from agricultural conglomerates who want to develop their carbon businesses. Decarbonization, it's a very, very hot topic. So I mentioned Archer Daniels Midland. Obviously, they're a huge player, but you could go to any of the large agricultural conglomerates, Cargill, what have you. They're all expanding in decarbonization. As Green Plains, this would be a very nice little bolt-on for them. To be honest, their plate might be a bit full, so I'm not saying they're the most likely acquirer. You could even go look at upstream or integrated oil names who are looking to decarbonize or kind of build out their renewable businesses as well. Obviously, Chevron bought Reggie, which is primarily an ethanol player, and they're moving into renewable diesel. But again, this is kind of very analogous kind of trade. So you could look at oil majors as well. I mean, there should be, and the final point I would make is this is not a big purchase, right? We're talking, even at the numbers I'm talking about, a few $100 million. Once you divest of the crappier assets, you get 50, 60 million back from that. So we're talking close to 350, 400 million. This is not a big ticket transaction for what I think is a pretty interesting asset. So there should be a lot of interest.
Let me ask, I think there's a lot of questions around here, right? Like, is the company going to do it? But I think the main question I have when I look at this, a lot of people who are going to have when they look at it, they're going to say, okay, Jeremy, this sounds great. Obviously, there's a big trend coming. You can go read the GPRE and IRA teaching day from 6 weeks ago or whatever. It's really informative. But when I've talked to really smart investors on ideas like this, they say, look, I understand. You're making a great pitch, but here's the issue. None of this is economic in the sense that, especially ethanol, the whole ethanol and the subsidies and everything, it is just the stupidest thing. One of the stupidest things the government does, right? Like, hey, let's take all of our food stock and let's throw it into our fuel supply for green reasons, except when we throw it in our fuel supply, we're releasing tons of carbon dioxide and, it's increasing our food supply. It makes absolutely no sense. And a lot of renewable diesel, biodiesel, whatever, a lot of them do that. And a lot of the people I talk to just say, hey, I just can't invest in something that doesn't make sense, even if the big things are there, because when you rely on government subsidies, like the ethanol industry is very powerful. The corn industry is very powerful. Ethanol has been here for what, like 20 or 30 years, and everybody's saying it's stupid the whole time, and it hasn't gone anywhere. It gets really locked in. But when you rely on stupid subsidies, like sometimes they just get yanked away like out of nowhere, and people just can't. A lot of people just don't want to underwrite that political risk. So I threw a lot out to you, but that is like the overwhelming question I have when I look at things and things like this, and I think a lot of investors will have.
Look, it's a good question. I mean, I can't really push back too hard on it. There's definitely pen stroke risk here. I mean, what I would say is probably this. You know that old saying, approach the world as it is, not as you wish it to be. So you and I both know these subsidies probably have all kinds of negative concomitants and are not economically rational, and not the best use of our food, agricultural industry, whatever, long term. And yet, do you see the winds blowing any different way? I mean, look at sustainable aviation fuel. Okay, let's look just for an example. Everyone knows jet fuel is one of the last kind of fuel markets to be decarbonized. The kinds of subsidies the IRA is incentivized for SAF are just absolutely insane. So they're depending on the carbon intensity, meaning the amount of carbon dioxide that gets created, or I guess dispersed into the atmosphere per unit of production. Depending on the carbon intensity of the SAF production, the subsidy will be between $1.25 and $1.75 a gallon. So as high as $1.75 a gallon at the federal level. Then you have a bunch of US states also talking about giving secondary subsidies that are allowed to be double dipped, by the way, for the exact same production, again, over $1 a gallon. Like, for clarity, this ethanol right now, commodity ethanol trades at $2.30, $2.40 a gallon right now. If you can turn it into SAF, you're going to get what, 100, 150% margins? And the pathway from turning fuel ethanol, fuel alcohol to sustainable aviation fuel, you've got to crack a few molecules. There's a chemical pathway to do it. You got to spend a bit of money, but it's just insane. And so do I think that subsidy is going to exist forever? No. But then I look at what other countries are doing, and look, the EU is mandating you have to have a certain amount of sustainable aviation fuel within your blend as an airline by 2030. Japan just instituted some massive new mandates for having a certain percentage of sustainable aviation fuel. There is a massive shortage of this stuff. So what I would say is, despite our best intentions and we're both investors, with both kind of economically rational, we like to think that way. These subsidies, they have a tendency to keep getting extended, right? They have a tendency to, as long as the political will is there within the electorate, you can kick the can for quite a long time. And frankly, because this, what I would say is this, to answer your question specifically, I'm much more bullish on the long-term SAF potential than I am on, say, the 45Z portion of the credits for carbon capture and sequestration specifically, right? However, because CCS, decarbonization of the ethanol molecule, let's say, because that's a gateway to all these other SAF-related subsidies, you're actually in a situation where even if the subsidy that is the carbon sequestration subsidies only last for, say, 4 years, and at the moment some of these are scheduled to actually expire in 2027, so they do have to get their act together. Even after that, if you're no longer getting the carbon sequestration subsidy, but you're getting $2.50, $3 a gallon total for your SAF, and you're making SAF from 27, 28, you're laughing. You're absolutely laughing. So I'm actually much more comfortable underwriting kind of this long tail to SAF kind of institutionalized demand, that given how crazy our political leaders are. But no, I mean, it's definitely one of the key risks. I would say, if I was looking at this kind of sector in general, GPRE or Alto, whatever, I would, a Republican sweep next year is probably one of the bigger risks, because we all saw what McCarthy tried to do with the debt ceiling. And obviously, if the Republicans sweep, then they're probably much less supportive of these kind of policies.
But you say that, but a Republican sweep also, like, a lot of the Republican senators are from the Midwest states that, like Chuck Grassley from, I can't even remember, what's the state? Is it Indiana? Is that where he's from? Iowa. He's like the leading proponent of RINs and all these types of subsidies, because he's got tons of corn in his state. So Republicans, I mean, our vision of Republicans is probably like slash spending, slash taxes, get away. But these things are really deeply ingrained in the Republic. Like a lot of these subsidies are actually, it's a little bit bipartisan, right? But bipartisan, because a lot of the Republicans just want to subsidize their corn production, and a lot of the Democrats want to subsidize anything that is green or quote unquote green. So it is a risk, but it's interesting. Let me turn to the other big risk here, right? And that would probably be management. And I've got in my notes, I'm looking over here, you mentioned earlier, but one of my notes from reading their calls, I just have a quote that says, these guys are trying to do way too much at once, right? Just way too many capital projects. I think management, and you published the letter this morning. We haven't heard back from them. There is a semi-shareholder friendly member on the board. There's been insider buying. We can talk about all that. But I think management might look at this and say, hey, why are we going to sell now when the pot of gold is here? And with 2 years of capital development, we can kind of realize that pot of gold, right? Why are we going to sell for $5 per share today when 2 years from now, with a little capex, we could be talking about hundreds of millions of EBITDA, and we could be talking about selling for $2 billion or 20 or 25 or whatever the number is. And I just want to pause there and add on, you've got appendix 2 or 3 at the back end of your thing. The CEO here, he's been in charge for about 10 years. I don't know if shareholder value has been a particular focus given the share price, but he's gotten paid a lot, right? And he doesn't own a crazy amount of stock versus how much he gets paid. So I could also say, hey, not only is there the why sell before the pot of gold is really here, but the insider incentives might be, hey, let's just keep betting on the come, because this is a problem with a lot of companies. We're getting paid a lot. So why sell today when we can just keep making money?
I mean, it's an excellent question. It's always the rub, right? I would say, look, you sell because your shareholders get to a point where they're fed up and force you to sell. That's point one. I mean, if you look at the register, let's look at the register. The largest disclosed, well, I'm at 1%, okay, so it's not a huge position, but the largest that I can see, I don't have Bloomberg, I only have ticker.
I'm looking at my Bloomberg right now, so I'll fact check you on the spot.
The largest disclosed active shareholder, so not a passive index piece or whatever, that I saw was like 2% of the company, 2.5% of the company, something like that. Look, I've heard rumblings there may be other large active shareholders who have not disclosed because they're not above the 100 million AUM threshold that they have to disclose their position, and they might have a few percent of the company. But either way, this register is completely and utterly fragmented and open. That's point one. Point two is, if you look at the traded volume, this register has turned over twice this year alone. As I said, this stock peaked at about $6, $6.50 last year. My thesis is you can get at least $6.50 in a sale. You mean to tell me the register that has turned over 2 times in the last 6 months, probably 3 times in the last 9 months, that there isn't support for, what, a third, more, half the register where their cost basis is $3 to get 100% premium and a certainty of value, as opposed to keep listening to the Pied Piper running the company and take his word for it that he can actually make the investments and get them done in time and on budget, and not actually have to kind of have a disaster before ethanol rolls over again and kind of put the whole thing at risk because this is still a little bit levered. Look, ultimately, I'm not always on my high horse with like, oh, the shareholders always get what they deserve. It's certainly not like that, but there isn't a major shareholder here who's like, this isn't a family controlled business. This isn't a controlled company. This is, as frankly, as open as it gets. The register has turned over multiple times in recent months. And it's eminently feasible that they could clear 150% premium from their cost. Like, who's not going to, certainty of value. I'm not talking about a 10% premium here. I mean, this is serious premium. So I would think that shareholders will vote with their dollars first. And then in terms of the secondary, I guess the other point you made, why would they sell out when they can theoretically turn this into a massive cash cow? I mean, it goes back to our discussion on the politics. Yes, it appears to be a veritable bonanza right now. But there is always going to be pen stroke risk with these things. There is necessarily going to be this kind of, well, what's happening next election cycle? Or, next time the debt ceiling needs to be renegotiated, whatever, right? Like, so, yeah, they do have a window, certainly, the next few years. I mean, IRA is highly unlikely to be touched during its initial kind of implementation now. So they have until 2027. These guys didn't even publicly comment on the 45Z tax credits in any of their documentation. 45Z is the heart and soul of the IRA in terms of value regarding decarbonization. They only talked about 45Q. 45Q is wildly insufficient. if you go back and look at the GPRE teach-in, they go through the math on 45Z. Now, this is the key provision, and that you need to have your investments locked and loaded by 2027. And there is a big advantage to actually moving first because, as the guys at GPRE discussed, if you move first, then you get on the pathway to these other kind of opening up SAF and what have you ahead of everyone else. And that essentially means if 45Z does actually go away at the end of 2027 and doesn't get extended, you're still good to go. So the very fact that they've kind of been dragging their heels, or I don't even know if they've been dragging their heels, being pulled in too many different directions and cannot focus on this opportunity properly, which I mean is completely and utterly transformational, far more than any of the other projects they're working on. It doesn't lend them a lot of credibility in my view.
You and I have I'll just call it a refiner investment in common. I don't want to mention it here because we don't need to dive down that rabbit hole. But one thing that strikes me is when they saw a similar path to SAF, right? A similar path to renewable diesel, like lots of government support, all this sort of stuff. It's not like they shut everything in the rest of the business down and didn't do anything and burn it to the ground. But they basically said everything else is, as steady state as is. We're going to make sure we run it. But the whole company is singularly focused on this one opportunity because it is so large. And I am kind of struck, as you're basically saying here, like Alto 45Z, I knew about it because I know of oil companies that have pipelines and they're like, hey, we're getting oil out of the Permian or whatever. And because we're drilled down, like we've got access to geological formations that would be so great for 45Z. I'm simplifying a little bit or going up, but they were like, this is the best thing ever. We need to immediately start aggressively attacking it. And here you have a company that is so perfectly situated for it. And instead of like aggressively, immediately, as soon as this comes out, going all out at it, they're kind of saying, oh, we'll go after that. But, we'll also try to increase our corn yield from 1% to 1.1%. And not that the other things are great, but to shareholders, all they should be talking about and focus on is this, because as you're saying, the opportunity is so large. Let's see. Just one other thing I wanted to rant about. I completely agree with you. Like, this is a $200 million company, and I look at the board, and the board in total owns 4% of the common. I mean, if this was a $4 billion company, 4% might be okay. But like, whenever you've got a company under 500 million, and I ask companies to invest in all the time, like, if you're under 500 million, you need to have a serious shareholder on the board. Like, come on, there's got to be a guy who owns 3%, 4%, 5%, whose one focus is, hey, I get paid when the price goes up and shareholders make money. Because the rest of these guys, if you own 1% of a company, the CEO, he owns 900,000 shares. Cool. That's 1.8 million. I think if I remember correctly, he makes 2 million per year. I'm kind of trying to flip through here, but it's like he's 75.
He does, yeah.
Yeah, he's 75. Yeah. He gets more money from salary and bonuses than he does here. He's not fully aligned with shareholders. So just to jump my hires there. We've covered a lot on Alto. Again, we got a lot of other questions on other stuff we can quickly bounce through, but and I think we've mainly covered everything. Again, your letter will be in the show notes. Anything else people should be thinking about with Alto here, though?
No, I mean, I think that covers it. Look, there's kind of a transformational story. These kind of historically bad commodity assets have been given a new lease of life, largely through this decarbonization opportunity. A lot of what you mentioned is correct in terms of management risk and a bit of pen stroke risk. Those are the two risks to kind of due diligence or think hard about if you are looking at this. But the value to acquire is very, very clear, very, very straightforward. And I should highlight, I did mention it in the letter, but given the amount of the register that has turned over, obviously I've spoken with a number of these investors. And I would imagine that presenting a market test where a competitive process results in something like $6 or above $6 a share in value presented to shareholders, I imagine that would be met extremely sympathetically by a plurality of the register. I'll just leave it at that.
Yeah.
But yeah, it's a relatively straightforward case in terms of the setup and the valuation and the kind of the numbers argument. But the lingo around the industry and kind of the ethanol industry and now the decarbonization story is there's a little bit of a technical lingo around that. So people would have fun diving into that, but the actual setup part of it's pretty straightforward.
And just one more thing, even if this company would say, hey, we think there's a huge pot of gold at the end of this rainbow. We think shares can be worth $20 per share 3 years from now. Like, you've got to at least go out when you've got an asset that is this strategic and has been this undermanaged for so long. You've got to at least go out and do a market check and let your shareholders decide, hey, we went out, the best bid we got was $6 per share. Here's our capital markets day where we present our path to realizing $20 per share of value. And here's why we think we should do it. Like, you've got to do one of those two things, but you've at least got to present a clear picture of both sides. I guess we could probably figure out the $6. They've got to present a clear picture of where they think they can go so people can evaluate, because the standalone just really doesn't work. Let's go to other things. One other Jeremy Raper special situation, FAR, which I think is in a much better place today than it was even 3 weeks ago. But do you want to talk about what's been going on with FAR? Because I think I got about 4 people asking.
Sure. I mean, look, I would love to try to remember when we last spoke about it. I assume it was, I think we did
on the podcast,
right?
It was like a year ago, but you and me personally was maybe 2 weeks ago.
Okay. Yeah. So this is kind of finally coming into form, as usual with these things, there's a lot of kind of back and forth behind the scenes, which is difficult to talk about. So if anyone was, they wanted more color or whatever on Twitter, it's not that I'm ignoring it. Far from that. It's just very difficult, when you're talking with management and other stakeholders to give a play-by-play and blow-by-blow, you know what I mean? But now it's all kind of in the public domain. But so essentially the company's decided to return, call it 90% of their excess capital, their cash on hand. So they're going to pay a 40 cents distribution. In Australia, the rules are you have to call a meeting for that kind of capital return. That meeting, they said that the documentation calling the meeting will be sent out in July. I assume that means you'll actually get the check. It's going to pass, obviously. You'll get the check in August. So, 6 weeks or whatever, 7 weeks maybe. Meaning, the stock's at 82 cents today, you're going to get 40 cents cash. That'll be a capital returns. There'll be no withholding, no nothing. So if you're a foreigner, it's totally fine. They are getting a tax ruling from the Australian Tax Office to confirm that. So that's a bit of a holdup. And thereafter, you're essentially left with the Woodside earnout and nothing else, basically. And so, look, I kind of made a few comments on Twitter. I would reiterate those. Once they've paid out almost all the cash, this really defrays the risk that they're going to do anything idiotic and buy something stupid with the cash. That was the key risk. Stocks rally, but I still get it's actually gone up a little bit more since I put out my last math, but probably about a 40% IRR from where we currently trade to where I think is a very, very reasonable low end valuation on the stub, on the Woodside earnout, which is, I think, about, very close to $1, maybe slightly under $1 a share. So basically what's going to happen is this thing's trading at 82 cents a share, you'll get your 40 cents. And assuming it trades at 42 cents, you have something trading at 42 cents for then residual 5 cents of cash and an earnout worth 55 cents, basically. Between 52 and 57 cents, depending on, your assumptions and what they select for. So is it going to trade at a 35 to 40% discount to the value of the earnout when that earnout is extremely likely to be monetized within 6 months or less? I guess that's for the market to decide. I don't think it will. There is no real reason for this entity to exist once they've paid out all the cash. So I assume they will monetize the earnout one way or another within the ensuing period. I think the question is less about them doing it now and more about what they get for it and how long it takes. But even then, you still get you get very attractive kind of risk-adjusted returns, even if it takes 9 months from today. And even if they get, you run it with a 25% discount rate, you still get kind of like a 30% return.
I was just going to say that's been such good work on your end. I mean, I think that might have been the first podcast we did, maybe the second podcast we did, but we talked about it. And that was a board that, in my opinion, was very recalcitrant to kind of do anything. And you obviously led the charge there on, because they wanted to go buy something, if I remember correctly. They were looking to, they had all this cash, they had the earnout, and they were looking to stay as a going concern. As you said, insiders don't own a lot of stock. It doesn't make sense to liquidate. It makes sense for them to keep it going so they can keep collecting a salary. And mainly you led a big charge here to say, no, your stock is at 50 cents and you've got $1 of cash and assets. We need to liquidate this sucker.
I appreciate it. Look, it's taken definitely longer than I imagined. I mean, I first got involved in this early 2022, maybe January, February 2022. So it's definitely taken a lot longer than I thought, as I'm learning, these things tend to do. But it is gratifying to get, I think, the right outcome, maybe on a slightly long timeline, but the right outcome, and to hopefully provide a lot of value for all my compadres along the way.
How are you looking at met coal these days?
Okay, that's a good one. Look, probably not the right guy to ask, given I called it pretty wrong. I mean, look, I was one of those guys who thought the Chinese reopening would kind of be a lot stronger than it was. Color me a dissatisfied commodity bull. I mean, look, I've lost the most within my book. Commodities has obviously been the most biggest pain point this year. More so met coal, more so coal than oil, to be honest. these things were trading at insanely cheap valuations, and guess what? Spot went down, and they're trading at even crazier cheap valuations.
That's what's been so crazy about these things. Like, okay, when oil was, I'll just use round numbers, 100. I would say every oil company was trading at a price that would imply like oil was trading at 65, right? And now that oil's trading at, let's call it 70 to make it more fun, but oil's trading at 70. So actually the cash flows that they were trading at, where they were trading, would have implied a discount to even after this 30% drop. But now all the companies, or most of them I follow, are trading like oil's at 50 or so. And it's just like, gosh, darn it, I'm damned if I do, damned if I don't. And maybe the answer is like these companies, there is absolutely a bad capital allocation discount baked into all these things where everybody's worried that managements are going to just blow the massive cash flows they're generating even at these depressed-ish prices. But you just look at it, you're like, man, what's it going to take for me to make money on these things aside from these companies just like buying themselves out or something? I don't know.
Look, I mean, I think David Einhorn was right. Didn't he say you're never going to get paid on these stocks re-rating? You're just going to have to get paid on the capital returns. They're going to have to pay the dividends. You'll get paid on the company eating itself. You're not going to get paid on, oh, this is a coal company. It shouldn't trade at 1 times EBITDA. It should trade at 5 times EBITDA. That's just not going to happen. So, by the way, I never really expected that to happen, but I thought it would hold its multiple at, 3 times or whatever. And no, it went to, so, I own this Aussie stock, SMR, Stanmore Coal. It trades at like 1.5 times EBIT. And by the way, that's not on peak earnings anymore, because that's on met coal that all of a sudden is like, what, 220 a ton or whatever. It's very respectably within the long-term range at this point. Like it's definitely still, upper quartile, but it's not, super normal profits by any stretch. By the way, this is not unique. This is all kind of, Alpha. You can look at Alpha, you can look at Arch, you can look at HCC. These all kind of trade 1 to 2 times EBIT, let's say. One way I like to look at some of these is on an EV per ton basis. And so SMR actually bought these assets from BHP in a deal that was an absolute home run. They bought, of their kind of 12, 13 million tons per annum of production, they bought like 80% of it from BHP. So it's essentially an old BHP mine. And they paid, 150, let's say they paid $150 a ton. And now the implied EV is like 110 or something, 115.
It's crazy that you look at, so the share prices almost invariably are up since the absolute COVID lows. But because these guys have generated so much cash and paid down so much debt, like many of them are actually trading not just at a discount to where they bought their assets when spot was way lower. They're trading at a discount to where they were trading at the absolute depths of COVID lows when people were like, oh, like, economic activity is going to be down 10% forever. And we'll never need coal again because our energy demand is so down that we can just use nat gas or like. It is just absolutely wild how cheaply these things have done. And, I do think people worry, and I've been saying this for 18 months. People worry, oh, what happens when we hit a recession and demand goes down and prices drop? It's like, that's when you want to wait for the recession to buy these names. And yeah, I guess that might be true, but people forget a lot of these names used to go into recessions with 2 times leverage. So earnings would go down. So all of a sudden they'd be like 10 times levered. And as an equity player, you'd just be hoping and praying they didn't breach a covenant and need to file or go bank. And now all these guys have like negative 2 times leverage because a lot of them are net cash, or at least they're net neutral. So if you go into a recession, there's no bankruptcy risk anymore, right? So you're talking about very different companies. And yeah, it's just, I mean, you're more in the coal names. I'm more in some of the oil and nat gas names that instead of 2 times or 1.5 times, they trade for the shocking multiple of 3 times EBITDA or something. But it's been very frustrating. And I have one other rant. I've been very surprised you have not seen, I understand ESG, but a lot of these are very small. I've been surprised you haven't seen private equity firms come and buy these things out, hedge out the curve, and just mint the cash flows.
Yeah, I mean, I definitely think some of that's will happen at some point. I mean, I do think the next Glencore will get built this way. There is some big bad Dr. Evil type dude who doesn't give two. Can I swear on this podcast? I'm not sure if I can. So I won't.
Yeah, you can.
They don't give 2 fudges about ESG. So they're gonna come along and buy up half these companies. What's interesting to me, I would say 2 points to add on to what you thought. I agree with most of what you said. I would say 2 things. One, despite everything you say, I'm not necessarily throwing more capital in these valuations, because as cheap and as irrational as current prices are, I had some chunky positions and I'm down on some of them, having traded a few of the thermal coal names quite well last year. So I'm okay on those. But nevertheless, in met coal, I'm underwater fairly on those, and I haven't been adding to them just because the opportunities out there are just crazy and stuff that's much more actionable. Like right now, what's the catalyst? The catalyst essentially spot price stabilizes. We do or we don't go into a recession, but spot price appraises like, and they generate a shitload, tons of cash flow, and we get the cash flow back. I mean, that's great, but am I going to dedicate incremental capital there versus say a FAR, time bound? I mean, of course, completely different liquidity profile, much smaller, wwhatever. So this isn't for everyone, but things like or something like an Alto, where I can either hopefully generate a lot of value through my own work, or just it seems like it's a much more kind of time sensitive, time bound way to not get in and out necessarily, but to kind of extract the value, for want of a better word. So things like that. There's a lot of stuff like that to do.
Look, this is the nice thing about being Carl Icahn. You buy the stock and you can go be your own catalyst. That's the nice thing about being Jeremy Raper.
Yeah, you know what? Heavy lies the head that wears the crown and all that. But no, it's just there are a lot of these opportunities where, for whatever reason, I just feel like there's a more near term catalyst or ability to get that latent value out of the equity and into my pocket versus some of these commodity names where, let's be honest, they're a dime a dozen, right? To your point, there's a whole swathe of Canadian E&Ps and US E&Ps and gassy names and coal names. I mean, probably there's like 50 of these names across commodities where they're all trading at insane valuations that may as well all move together when things stabilize, and picking between them is a little difficult, and some will get picked off and maybe we'll be lucky enough to own those, but just a bit trickier, I feel like, in some of the more special situation stuff that has been very fertile, I should say. I'm not sure if you had any questions on it, but the special situation stuff has been very, very interesting in the last kind of 6-9 months, and where I've been focusing most of my time.
And now, a quick word from our sponsor. Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are, and you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time.
This is, did you see Lilly announced a deal to buy, neither of us had any position, I can almost guarantee. Lilly announced a deal to buy Sigalon this morning. Did you see this thing?
No, I haven't been watching this thing.
The stock was trading for $4 yesterday, and Lilly announced the deal. Let me see if I got this right. I think it's $11 per share cash plus a CVR. It's $14.92 per share cash plus a CVR that could be worth like up to $100 per share. The stock went from 4 to 29 overnight. Anyway, I just mentioned it because you said, "Oh, you might get lucky to be a takeout," and I was like, "Man, I would like to be lucky enough to get a takeout like that Sigalon thing."
Well, tomorrow when Valero buys Alto at $8 a share, we can rerun this podcast and laugh at each other.
$8 a share plus an earnout for $16 per share, depending on how the 45Z credits come in. The ticker there was SGTX, if anybody's interested in that one, by the way, but I strongly doubt either of us have a position there.
$8 a share plus a voucher for a free ethanol refill at any of the Valero gas stands in California.
I love that. Or, if gas prices go back to where they were last year, maybe just fill up your Hummer once or twice. Cool. Well, hey, Jeremy, it's been over an hour. This has been great. Look, I want to remind everyone, the main focus of this podcast was Alto, as we just ended up talking about. Link to Jeremy's letter will be in the show notes, especially if you have a position. Obviously, Jeremy's going a little bit activist here, where neither of us, especially Jeremy, are not trying to form a group or anything. But if you agree with what Jeremy says in his letter, I would just say for him, it would probably be worthwhile to shoot a note to the board. Say, hey, I own 10,000, 50,000, 100,000 shares. I agree. Let's run a market check. Let's at least see. We've got a standalone plan. How's that value measure up against what a strategic would say? So I will say that for Jeremy. Jeremy, I think this might be your 10th podcast. So I appreciate you coming on and looking forward to the next one, man.
Dude, thanks for having me. It's always a pleasure. I appreciate it. Speak soon.
Later, buddy.
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.